Welcome to the Freedom First Retirement Podcast, where we strive to simplify your financial life and provide you freedom from taxes, risk, stress, and poor advice. And now, here are your hosts, Darrin McComas and Sean Peel.
Hey, welcome to the Freedom First Retirement Podcast. I'm your host, Darrin McComas, and hope everyone had a great Thanksgiving. Today's date is November 25th, 2022. Hey, just wanted to go over a few things with our clients. I think there's a lot out there swirling in the media. And one of those topics we want to talk about today is recession. Our analysts at Hedgeye Risk Management are calling for a recession. They think a recession is imminent if we're not already in one. So let's kind of dig into some data that suggests why we have this viewpoint and what we're going to do about it when it comes to investing in this kind of market setup. One of the key points that we look at here, and if you're following us on YouTube, we have some charts here for you. And if you're listening to us just audio only, bear with us. We'll kind of talk through these different graphics and charts as we go through here. But one of the key indicators that backtests very well is the 2-year versus the 10-year U.S. Treasury yield. Just the other day, it was at a frosty cold minus 77 basis points. So usually when these invert, in other words, the shorter duration, the 2-year is paying a higher interest than the longer duration, 10-year, that is a telltale signal that we are either heading for a recession or are entering a recession right now. So if you think about this, you should get paid a higher interest for having a longer duration risk. So a 10-year typically will pay a higher interest rate than a shorter duration 2-year. This is, of course, completely inverted. So when you hear, people on the media talk about yield curve inversion, this is exactly one of the metrics they're talking about. So minus 77, that is extremely inverted. And of course, a lot of people think the deeper you go, the deeper inversion, the deeper the recession. And here's another chart that we're looking at here. You can see just that flip, that inversion here on the chart between the 2 and the 10. And that spread is getting wider and wider. And I'll just reiterate, the Fed and Jerome Powell control that short end of the curve. The 2-year, the shorter duration end of the curve is controlled by the Fed and its policies. The 10-year and the longer duration treasuries and bonds are controlled more by the market. And so the market kind of prices in those yields. So we have this divergence here. The 2 years going vertical, the 10 years starting to roll over and come down, and that's causing this big inversion. Another huge indicator besides the 2-year, 10-year is the 3-month versus the 10-year. So 3-month, very, very short duration, and that actually is paying a higher yield than the 10-year. So I think the 3-month versus the 10-year has like a 99% accuracy when you back test it. And this chart right here that we're showing you with those red arrows are points in time over the last, 20, 30 years where the 3-month and the 10-year have inverted. And then you see those gray bars shortly afterwards. Those are periods when the U.S. entered a recession. So you can see the deeper that inversion, usually the longer that is inverted, the longer the recession is. The last time we had this was during COVID, when the pandemics and the lockdowns occurred. The 3-month and the 10-year inverted, and we went into a very short recession here in the United States, and then we quickly came out of that. But here we are again. The 3-month, 10-year just inverted this year, and it has stayed inverted for a fairly decent amount of time. And of course, time will tell, but those are pretty good indicators that we are headed into a recession. And, we overlay those facts with, Hedgeye, and they're our risk management team that we subscribe to. And we look at their quad map here. And if you remember, we'll kind of go through the quads real quick. Quad 1 and 2 are very bullish. That's when you have economic growth accelerating. That's usually generally very bullish for the markets. When you have when you're on the bottom half of that chart, that's quad 3 and 4, that means GDP, economic growth, is decelerating. And then on the left to right axis is inflation. So I put a big red arrow here on this chart. I think this is very telling. This is the first time we've seen in quite some time that fourth quarter expectation really change. And it was previous to this update was hovering right along that x-axis, but now we're seeing a rapid deceleration in U.S. Economic growth forecast. And so fourth quarter 2022, which is what we're in right now, shows a pretty deep quad 4 setup. And then a first quarter has also shifted down a little bit, also in quad 4. Second quarter of next year, way to the left here. So that means inflation is coming way down, but still hovering in that quad 4 sector. But the good news is that I put a big green arrow here. Our analysts are projecting sometime towards the second half of 2023, cycling out of this and getting into a more bullish setup. And they have third quarter of 2023 kind of sitting there between quad 1 and quad 2, which is a good sign. We've been pretty bearish for most of the year now and heading into the first half of next year. So a very bearish setup, but it's nice to see some light at the end of the tunnel. So not all bad. Of course, the markets will price that in months ahead, but I really think Hedgeye has this nailed. There's going to be more pain coming here in the coming weeks to coming months before we see a more bullish setup. And so really we feel we're entering the stage 3 of quad 4. So there's kind of 3 stages to a quad 4 market setup. We feel we're in this transition out of stage 2, more into stage 3. Stage 3 is when you get this demand destruction, right? As both growth and inflation are decelerating. And now this kind of setup should behave more typical of what we consider a quad 4. That's when you want to be long bonds, more into that fixed income, longer duration, safe assets. Those were really tough in 2022 as interest rates were rising, high inflation, rates kept going up, and that really was a bad setup for fixed income and bonds. But now we're starting to see that roll over on the longer duration, the 10-year, the 20, the 30-year durations are starting to show signs of life. Precious metals also is a great place to be. And typically in a quad 4 market setup. So gold, silver, platinum, we're starting to see those come to life and start to turn bullish trade and bullish trend. And then utilities, anything that's rate sensitive, that likes falling interest rates, are also starting to come to life. And then the dollar, the US dollar remains bullish, and usually they call the dollar the wrecking ball in quad 4, and that's because the dollar is appreciating as more and more people sell stocks and just kind of park their investments in cash. Cash becomes more scarce, and then things that are more scarce become more valuable. In 2022, we're getting down to the end here. We only have a little over a month left. In this year, and it was really the everything bubble, the dot-com bubble of 2000, when all those failed internet companies blew up, was one thing. The housing bubble of 2008 that led to the global financial crisis, that was pretty much centered on one thing. 2022, with all this easy money that was injected into our economy as a result of the pandemic, has led to what everyone's calling the everything bubble. Housing, crypto, credit, equities, on and on and on. These things all inflated extremely fast and wildly overvalued. And we started to see one by one these bubbles pop. Crypto has been absolutely going down in flames this year, as you could see, one after another exchange blowing up. The housing market has pretty much imploded. Here's a great chart just to show you purchases versus refinances, just basically fallen off a cliff. Very few people are going out and buying a new home or refinancing with interest rates so high. And just talk to your local realtor or just do a quick search on Zillow, and you can see how many houses around your neighborhood have just lowered prices or just pulled off the market completely. So, crypto housing is imploded. Here's a great chart of Bitcoin. People about this time last year, I remember, going to some holiday parties, talking with friends that were all caught up in the cryptocurrency mania, telling me I should buy this or that, or, hey, what do you think of this, Darrin? You're a financial advisor. Of course, I was warning them that I thought it was all going to crash. And sure enough, Bitcoin is now trading well below 20,000, down over 70%. So, bubble after bubble. Here's a new one, consumer discretionary. And the ETF that tracks that is the XLY. Year to date, down 33%. People are feeling the pain with this high inflation and making some tough choices. Do I, fill up the gas tank? Do I buy groceries for my family? Or do I go buy that, 70-inch flat screen TV? And this chart says it all. They're definitely kind of tightening the household budget, so to speak, and those discretionary items are being put on hold, or just, they're just not feasible right now for the average American. Here's a great chart of the heat map of the S&P 500. For those listening only to the audio version of this, it's basically a sea of red out there for the S&P 500, with some of the best companies like Google down over 30%, Amazon over 40%, Apple's hanging tough. That's kind of the last one to crash here. It's down about 15%, but there's only a couple sectors that are green on this whole chart, and that would be energy. Of course, Exxon, Chevron, these big oil and gas companies have profited very well this year. And then healthcare has done pretty well, minus Pfizer, I would say. Most healthcare companies have done well during this reopening, as people are getting back to their doctors, and we're starting to see healthcare really pick up. And then aerospace and defense has also been a pretty good one. So outside of Boeing, just about every aerospace and defense company out there has posted some positive returns this year. And of course, a lot of that has to do with the war in Ukraine. A lot of money being spent on weapons and money being shipped over to Ukraine. That's a whole nother subject, but you can see why the aerospace and defense energy has done pretty well this year. We kind of wrap up this macroeconomic outlook here. Inflation has peaked. It peaked way back in June. That's when inflation was around 9.1. But it's got a long ways to go. The Fed and Jerome Powell, their target is a 2% inflation rate. Last month we were at 7.7, came in lower than expected, and the market really loved that. But again, we got to be careful what we wish for. Usually, when inflation is decelerating like that, that puts us into that quad 4 setup, and we know how bearish the markets are when you're in quad 4. So inflation, while it has peaked, it is coming down. It's still got a long ways to go, and part of that is just demand destruction. I think this is that stage 3 that we talked about just a minute ago for quad 4. That's when people no longer have money and they're hitting their credit cards. And you can see this chart right here, that red line is consumer loans. So credit cards and revolving debt just rocketing upwards to all-time highs. And we put a big red arrow up there. This is at the same time people's personal savings rate have just cratered. So people obviously are feeling the pain of this high inflation. And even though it's coming down, people, they just don't have that discretionary money. And if they're living paycheck to paycheck, you can see that they're having to, they're running into a shortfall. So they're having to hit those credit cards more and more and more just to make ends meet, and at the same time depleting their savings. So this is eventually going to run out, right? When you start hitting your credit limits and that credit card is barely getting paid off, that's when you start to get that real demand destruction. And then, of course, to follow that is the labor market. Some other signals that we are heading into this deep quad 4. Gold has been awful this year. Gold's typically one of the places you want to be during a quad 4. It's one of the best asset classes, back tests very well to quad 4. Does not like high inflation, does not like a rising interest rate environment. So gold has really struggled this year, but now gold is starting to come to life. We're starting to see the volatility of gold come way down, more into that investable bucket that we always talk about. So I really anticipate gold to maybe have a strong end to 2022 and really rally hard into the beginning of next year. So we're starting to phase some gold back into our portfolios. And kind of want to wrap up today's episode just talking about, what works in quad 4. Why do we want to stay invested? And why don't we just want to sit out in cash? There's always a place to go somewhere that's bullish. And the places we typically want to hang out in a quad 4 setup would be those flight to safety plays. So when people get scared as the market starts to crash, where do we go to try to get some alpha, to try to generate some positive gains? Those would be fixed income. We talked about that a little earlier. Those longer duration bonds are really starting to show some signal strength. So we are starting to nibble at some longer duration bonds through the ETF with the ticker symbol IEF. Gold is also coming back into our portfolios. Again, small sizes to begin with here. We'll see if gold can maintain its trend. And then we're going to keep a big position in the dollar. That's one of our largest positions. And while it did pull back a little bit the last few weeks, we do expect the dollar to resume its bullish trend upwards. And utilities, we're going to look at utilities hard. So far, we haven't got it hasn't not gone bullish trade and trend. So we've held off on utilities. But if interest rates on the long end continue to come down, we are going to probably head back into utilities. We have established some smaller position in consumer staples and healthcare through a couple ETFs. And then defense, we've also started to add in some defensive ETFs. As long as this war in Ukraine continues to grind on, we feel those are a safe place to try to generate some good returns. So, I get asked this a lot. Why don't we just sit in cash? We want to, position into the things that backtest well for quad 4. And we do want to have minimum drawdowns, but we also want to generate some good dividends, some good chance to grow our portfolio and get back some of these losses. So this is going to be more, I think, of a typical quad 4 setup. And I really like how our portfolio is positioned. Still very, very conservative, but a chance to, do slow and steady and get some good growth here. Of course, time will tell on that. And to wrap up today, we're getting into December here, and the deadline to do a Roth conversion is rapidly approaching. We only have a couple weeks left before we have to have those Roth conversion forms submitted to TD Ameritrade for processing. So, if we haven't talked to you yet about doing a Roth conversion, please feel free to reach out to us. Say, I want to do a Roth conversion. Our rationale behind doing Roth conversions, we're talking about 401k or traditional IRA money and moving it into a Roth IRA is to take advantage of these historically low tax rates. So, we only have a few weeks left in 2022. And if it's not turned in, that form's not submitted around December 15th, we've missed out on a year of taking advantage of these Trump tax codes. They do expire, however, at the end of 2025. So after this year, we have 3 more years under the Trump tax codes to convert money. So there's always opportunities ahead to do that as long as no new tax laws come into place. And honestly, my opinion on that, with the gridlock that we have in DC, now that the Republicans took the House, I really don't see any new major tax legislation being passed in the next couple of years. So we're going to take the stance that we're going to be under the Trump tax codes, at least for the next 2 to 3 years, with no new major tax legislation being passed. I just don't see a bipartisan effort there. And lastly, today, we're getting to the end of the year, and that, besides Roth conversions, required minimum distributions. So if you are 72 or older, or if you have a beneficiary IRA, maybe you inherited an IRA from mom or dad, you also are subject to required minimum distributions. Those have to be withdrawn by December 31st. And if we don't do it, there's a pretty hefty penalty that the IRS can slap on you if you miss that required minimum distribution. So if you just came to us this year, you're brand new to Abraham and Company, and you are 72 or older, or you have a beneficiary IRA, TD Ameritrade does not necessarily alert us that you have an RMD, because that is based off your account balance as of December 31st, 2021. Of course, if you're new to us in 2022, TD Ameritrade does not have that account balance from last year, so they are not calculating that. So it's really important that if you fall into that camp, that we make sure we work together to get your RMD calculated and get that taken out and sent to your checking account or savings account, so that we can satisfy that RMD for 2022. And of course, that includes annuity money. So if you have IRA money that is in a fixed index annuity, it really is an aggregate of all of your personal IRA money. And we got to make sure we run that calculation correctly and come up with that total amount. And we typically will take it out of your account at TD Ameritrade. You also have the option of taking the RMD directly out of your annuity for that portion. So contact us. We'll gladly walk you through the best way to take your RMD and make sure we get it done correctly. And again, I know this is a little late, a day late past Thanksgiving, but I hope everyone had a wonderful day on Thanksgiving and got to spend some time with friends and family and just really celebrate the season. And I know we are very thankful for our clients. We thank you for trusting us, and we don't take that lightly here at Abraham and Company, and we're going to continue to work hard for you. And as we head into this busy holiday season, don't hesitate to reach out. If you have any questions, if you need some extra income, this high inflation and everything costing more, don't hesitate to send us an email or reach out through phone and have that conversation. And we'd love to see your smiling faces and talk to you about just how life is going. So hope you enjoyed today's episode and found it useful. Again, hit that subscribe button and always be alerted when our next podcast. We're going to try to get these out every 2 weeks. Sorry for this one's a little delayed. Been a busy couple of weeks here as we're heading into the end of the year here. But thank you so much, and really look forward to finishing out 2022 strong. So stay safe, everyone. We'll see you soon.
Thank you for listening to the Freedom First Retirement Podcast. Make sure you subscribe so you don't miss any future episodes. For more resources, or if you have any specific financial questions, contact us at abrahamco.com. That's abrahamco.com. The Freedom First Retirement Podcast and related materials are provided for general information and entertainment purposes only and do not constitute accounting, investing, legal, tax, or professional advice. Visitors should not act upon the content or information found here without first seeking appropriate advice from an accountant, financial advisor, lawyer, or other qualified professional.